Okay. So today I thought of discussing accounting for partnerships, right? So we will try to do some important questions on partnership accounts. Okay. There are some basic videos also I have done, so I'll share those videos in the group. So when it comes to partnership accounts, right, it is a little different from the sole proprietorship. In a sole proprietorship business, we prepare the income statement and the statement of financial position. Straightforward and very simple, right? Because there is only one owner, the entire profit will be given to that specific sole proprietor, right? That's it. But when it comes to a partnership, the situation is a little different, right? Let's say, for an example, if there are two partners, the profit has to be distributed for both the partners. So the way of distributing the profit is also depends on how much they contribute to the partnership. For an example, let's say one partner, there are two partners, right? There are two partners. A and B, partner A and partner B, right? Partner A, he provide capital 100,000. Partner B provide capital 500,000. Right? So based on the capital, you know that you can see that partner B should get more profits because he provide 5 times more capital than partner A, right? So based on the capital, partner B should get more profits. And let's say the involvement. How much time they involve or contribute to the business. Say partner A contributes, let's say 8 hours into 5 days into 20 days, 800 hours a month. He's a full-time. He gives his full commitment, full time to the business. Can you all see the screen? Okay, that's right. Partner A contribution 800 hours a month. Let's say partner B contribute only 20 hours a month. He just come and have a visit. and participate for the board meetings, right? But he gives more investment, right? Then who should get more profits according to the involvement? So it's very clear, partner A should get more profits because his involvement is more, his contribution to the partnership is more, right? So likewise, there are different ways partners involvement or investment to the business. So therefore, when dividing the profit, let's say this partnership has a profit of 100,000. 100,000 profit. So you can't distribute this 100,000 50-50. 50,000, 50,000. Right? We have to use the different methods. So if for the capital, they can give interest on capital. Interest on capital. Let's say 10% interest. 10%. So if anyone is having more capital, they will get more interest. And also, they can pay salaries. So whoever involved more, they can decide on a salary package and give the salary. So it will give a portion from the profit as salaries. Right? So this salary is not an expense. It's the salary given from the profit, partner salary. And also they can share the remaining profit based on whatever their wish. Let's say 3:2 profit sharing ratio. Okay, so that is the main thing that we need to know in a partnership. So profit will be distributed among the partners in different methods. Right. And also in partnership, due to this reason, other than the income statement and statement of financial position, we need to prepare another set of accounts. Number one, partners capital accounts. Number two, partners current accounts. Partners capital accounts and partners current accounts. Capital accounts and current accounts. And third one is profit and loss appropriation account. Appropriation account. So there are three new accounts we have to create in a partnership, right? In capital account, there are transactions like the capital, investment of additional capital, withdrawal of capital, and there are two more special adjustments. Number one, the goodwill adjustment. Other one is revaluation adjustment. Revaluation adjustment, goodwill adjustment, and the revaluation adjustment. And current account, you have to show the distribution of short-term profits, where interest on capital, interest on current account, interest on drawings, share of profits will be adjusted in the current account. And profit and loss appropriation account is also same like the current account transactions will come to the profit and loss appropriation account, right? I'll explain from an example, right? Okay, so first thing, number one, the accounts and the profit distribution. And third point here is in our questions, you will get uh, uh, new admission or a retirement of a partner, right? So based on that, we have to do the questions. Okay, so we'll start with an example. Example one. And after that, we'll do the past papers. Example one. So as I said, the first thing we need to understand is profit and loss appropriation account, partners capital account, partners current account. So from this, we will prepare all these accounts. Right? This covers the entire process of preparing appropriation account, current account, and capital account. So this is the format for appropriation account. ABC partnership, profit and loss appropriation account for the year ended 31st December 2011. Okay, let's read the question. A, B, C are partners in a textiles business. Following were appearing in their agreement. Every partner who is involved in administration of the business shall receive monthly salary of 2,500. Right? Partners are entitled to 15% interest on the capital balances in the beginning of the year. 20% will be charged per annum for the drawings. 18% is to be calculated on the beginning balances of current accounts and to be accounted. A separate drawing account will be maintained in the ledger for the partners' drawings. This part, no need. I'll remove this. We don't need a separate account. Okay. Then 20% interest will be credited on loan given to the partnership by partners. The partner has given a loan, we need to pay 20% interest. Profit and loss, 3:1:1. Additional information, the administrative partner B is paid with 10,000 as his salary after every 4 months, and this should be shown in his current account. Then the balances, capital account balance, current account balance, and the loan balance. Drawings during the year, 15th of August, A, 12,000, 1st of September, B, 9,000. The profit before deducting the interest on loans and partner salaries for the year ended 31st March 2011 was 78,000. Okay, so we need to draw a profit and loss appropriation account, current account, and capital account. Can you all draw the format? You don't need to write the question, only the answer. Okay. Okay. So other than appropriation account, capital and current accounts, we also need a part of profit and loss account or the income statement. The reason is interest on loan is not an appropriation. When the partner has taken a loan from the business, from the partnership, sorry, this is a interest loan given by the partners. Loan given to the partnership by partners. Okay. If a partner has given a loan to the business will have to pay interest. So that interest is not a profit appropriation. It is an expense to the partnership. Therefore, interest on loan given by partners, that goes to the profit and loss account, not to the appropriation account. That is why we have a profit and loss account. Okay. Then let's record the information. So let's record the opening balances current account balances, capital account balances. Yeah, the current account, capital account, both are credit balances, balance brought forward. A 65,000, B 98,000, C 85,000. Current account 30,000 credit for A, C credit 10,000, but B is having a debit balance of 20,000. Opening balance. Write the opening balance. Right. So that is the beginning, the opening balance, and the net profit. You can write the net profit. The net profit before deducting interest on loans and partner salaries for the year ended 31st March was 78,000. So we'll put it 78,000 as the net profit. 78,000 net profit. Opening balances. Okay. Now let's do the remaining part. The following, we can start with additional information. Additional information. The following additional information is given to you. The administrative partner B is paid with 10,000 as his salary after every 4 months. And this should be shown in his current account. Right? And the following partners balances, we took everything and there is a loan. Okay, before the salary, let's do the interest on loan. Loan A and B only, 30,000 and 20,000. Then what is the interest rate? It's 20% interest credited on loan given to the partnership by partners. Interest on loan, double entry, profit and loss account debit, and current account credit. Calculate the interest on loan. Interest on loan. A, 30,000 into 20%. 30,000 into 20%. B, 20,000 into 20%. So this is 6,000 and 4,000. Total 10,000. And that goes to the current account. Interest on loan. 6,000 A, 4,000 B. Nothing for C. Right. So the interest is done. Then we can get the adjusted net profit. 68,000, that comes here. 68,000. 68,000 is the net profit after paying the interest on loan. 20% interest means it's given here, the question. 20% interest. Beginning, they have given this point. Okay. Right. Now, the next step is try to see for any interest on drawings and interest on current accounts. Because interest on drawings and interest on current account debit balances, we will add to the net profit. Because these are interest on drawings means it's a charge from the partners to discourage the drawings. There is a question where interest on loan, where do you show this? Is it in financial expenses? Yes. It's a finance expense, right? Okay. So let's check for interest on drawings. Drawings during the year is given. Drawings during the year. 15th August, 12,000. 1st of September, 9,000. What is the interest for drawings? %20 will be charged per annum for the drawings. So interest on drawings is 20%. Right. So 12,000 for A it was obtained, it was taken on 15th of August. Year end is 31st March. So can you all tell me how many months we have to charge interest from A? How many months do we charge interest from A? Uh, 15th of August means from August, September, October, November, December, Jan, Feb, March. 15th March, 7 months. So there is another 15 days, half a month. So 7.5, 7.5 months. 12,000 into 20% into 7.5 months. B, 1st of September means September, October, November, December, Jan, Feb, March. 7 months. So get the interest. $2,550 total. 1,500 and 1,050. These will be charged from the partners. So appropriation account credit, right, will increase, and current account will be debit. So in current account, always remember drawings, you have to debit, then you have to debit the interest on drawings. Drawings 12,000 and 9,000. Interest is 1,500, 1,050. Same side. Drawings, interest on drawings, both in the same side. Right. Then we have interest on current account. Most of the times it won't check, but let's understand double entry for that. Okay. Now, interest on current account means for the current account balances, we charge or pay interest. Now, if a partner is having a credit balance, the partnership, the business will give them interest, right? So if they have credit, interest also credit. If a partner is having a debit balance, then the partnership will charge interest because it's like a loan. Okay, so here B will be getting From B, we will charge interest. Interest on current account. And for A and C, the partnership will pay interest. Interest on current. So I first I'll do B. It's 20,000 into 18%. Yeah, it's 18%. 18% is calculated on the beginning balance of current accounts and to be accounted. 18% means 3,600. 18% means 3,600. And A and C. A and C, 30,000 into 18%, 10,000 into 18%. So 5,400, 1,800, that is minus and credit. 1,800. Right, so if a partner is having a debit balance, it's a income for the partnership. It's a receipt for the partnership. That is why it will be added to the profit. Then if a partner is having credit balance, they will pay minus. Okay. So can you all do the interest on capital? Partners are entitled to 15% interest on capital balances in the beginning of the year. So beginning balances are given at the top. Interest on capital. Remember, this question covers everything involved in the appropriation account. So most of the time, other than this, you won't get anything else. Everything covers in this question. Interest on capital, 65, 98, 85. That means 15%. $65 into 15, 98 into 15, 85 into 15. That is also credit. So 9,750, 14,700, 12,750, and that will be credited to the current account. Okay. Next, salaries. Let's do the salaries. Salaries. Here at the beginning, they say that every partner who is involved in administration of the business shall receive a monthly salary of 2,500. Then, in additional information, they say that the administrative partner B is paid with 10,000 as his salary after every 4 months. And this should be shown in his current account. This is the payment. On the top, they say about the payable, right? So there are two entries. Payable double entry is appropriation account debit, current account credit. Salary payable, that is 2,500 into 12. 2,500 into 12. Partner salaries. Only B. $30,000. $30,000. So there is salary payable. Then in additional information, they have mentioned after every 4 months, he get 10,000. So after every 4 months means 4 months, 4 months, 4 months. 3 times he will get the salary. Right? How much he gets? Total of 30,000 as salaries. That will be debited, credited to cash account and debited the current account. Salary is paid. Cash. 30,000. Okay. What else? Then the profit and loss sharing ratio. Okay, can you complete the rest? Okay. Next, we need to get the net amount. It is from 68,000. The adjustment. And it's a loss, share of loss. We get a loss of 250. So that will be shared among the partners based on their profit and loss sharing ratio 3:1:1. 3:1:1. David. 3:1:1. 150, 50, 50. 150. That's it. So we can complete the remaining. You take A, credit side is more. So you add 51, 150. Balance carried down. That's 37,500. That is the balance of A. Then if you take B, debit side is more. So you take total debit. $10,000. Then C, credit side is more. $24,500. Okay. So that is how we prepare the profit and loss appropriation account. Right. So nothing in capital account in this question is to understand the transactions in appropriation account and current account. Right. Let's move to another question. Let's move on to another question. Do you all have any doubts? Okay. Now, let's do a past paper. Let's do this paper, 2013. So in this, I'm going to explain the income statement part, right? Appropriation account, capital account, current account, and some of the basic ledger account. So this is like incomplete records. This is like the question we did incomplete records. Okay. Mahendra, Narada, and Rajita were partners of a trading firm, sharing profits and losses in the ratio 5:3:2. Statement of financial position of the partnership as at 31st March 2012 was as follows. So this is 2012, right? So look at the year end. We have to prepare the statements for 31st March 2013. So this is opening balance. Opening balance, we need to do the accounts for 13. 12, 13. Okay, let's start. Additional information. 1st of April, Rajita retired from the partnership. So This question I am going to explain the retirement of the partner. Right? You might get the question either retirement or admission of a partner. 1st of April means at the beginning. And remember, you won't get questions retirement or admission in between the year. You will get either beginning or end. Only those two. It was agreed to treat the amount payable to Rajita as a loan and pay interest of 5% per annum on it. On this day, the goodwill of the partnership was estimated 1.2 million, and all the adjustment in this regard should be made through the partner's capital account. So as I said earlier, goodwill and revaluation adjustments are done in the capital account. Mahendra and Narada agreed to continue the partnership under the following terms. Annual salary, every partner 120,000. Share of profits equally. During the year, Mahendra and Narada obtained 200,000 and 150,000 respectively as borrowing in cash drawings. All the sales and purchases of the partnerships are made on credit basis during the year. 1.8 million was collected from debtors, while 900,000 was paid to creditors. Operating expenses 350,000. Interest on loan are to be paid. That means not yet paid. PPE should be depreciated on 20% on straight line. Current assets and current liabilities at the end. Inventory, receivable, debtors, cash, creditors. Right, let's do this. First of all, we can record the opening balances from the balance sheet given. Right. We will record the capital account balances and current account balances. Capital account balance brought forward 200, 400, 200. Current account opening balance 150, 160. Okay, I will give few minutes. Can you all just try to do at least first 3 adjustments? I'll give 3 minutes. Do at least first 3 adjustments. Okay, so let's start. So in this question, one partner is retiring from the partnership at the beginning of the year on 1st of April. So as I always say, first draw the full format, then start with additional information. 1st of April, Rajitha retired from the partnership. It was agreed to treat the amount payable to Rajitha as a loan and pay an interest of 5% per annum on it. On this day, the goodwill of the partnership was estimated as 1.2 million, and all the adjustments in this regard should be made through the partner's capital account. Okay, so first let's do the retirement. So how do you do the retirement? When a partner is retiring, all his current account balances should be transferred to the capital account, right? Current account balances should be transferred to the capital account. How do we transfer? There is 60,000 in the current account balance. So that has to be debited to the current account and credited to the capital account. Yeah, I put capital. Yeah, you can put current. $60. So there is no balance in current account for Rajitha. There is no balance in the Rajitha's current account. We transferred the 60,000 to capital account. Next, the goodwill. Goodwill, 1.2 million. Double entry for goodwill is, remember, most of the times the goodwill double entry is this. You can write it as a note. Take the total goodwill amount and we have to adjust the goodwill in the capital account, right? So we have to credit old ratio and debit new ratio in the capital account, the profit sharing ratio. Okay, so I'll give the double entry. Capital account, debit old profit sharing ratio, and capital account, credit, sorry, debit new ratio, credit old profit sharing ratio. So this is how we record the goodwill. Goodwill double entry. Goodwill double entry. Capital account debit new profit sharing ratio, credit all profit sharing ratio. Goodwill. Old ratio credit. So what is the old ratio? Old ratio is given in the question as 5:3:2. 5:3:2 old ratio. And new ratio is equally share profits and losses equally. Old ratio is 5:3:2 here on the top. This is old. And equally is new ratio. Right. So 1200 is the goodwill. 1200. Old ratio is 5/10. That is 1200. Sorry, 1200 into 5/10. Then it's 600. Then 1200 into 3/10. 360. 1200 into 2/10. 240. 600, 360, 240. New ratio is equal nothing to R because R is retired. 600, 600. That's it. Goodwill. New ratio 600, 600. Then what we have to do is the retirement. R is retired. So retirement steps. I'll repeat the retirement steps. First, the current account balances should be transferred to capital account. Then the capital account balances will be transferred to the loan account. Now, if you take R, he has more credit balance. So total credit balance is 500. So that entire 500 will be transferred to the loan account. Loan. 500. So here is the loan account. We take capital. From capital, 500 will be credited to the loan account. right? Next, for this loan, the partnership need to pay interest in a retirement. This is the main part. Once you transfer the loan, since it's a beginning of the year, we have to pay loan interest. Loan interest is 5%. Here it says 5% loan interest. Additional information number 1. Pay an interest of 5% per annum. Okay, 5% interest. It is an expense. Interest on loan. %5 annum means it's 25. 25. Okay, so that's the interest, right? Next, Mahendra and Narada agree to continue the partnership under the following terms. Every partner is entitled to an annual salary of 120. So let's accrue the salary, partner salaries. So that will be debited and credited to the appropriation account and current account. Partner salaries. M and N. 120. Both 120. Salaries payable. Salaries. Share of profits, that is we have to do at last. During the year, Mahendra and Narada have obtained 200,000 and 150,000 respectively as drawings in cash. So we need to check whether is there any interest on drawings. I didn't see any interest on drawings. So we can just record the drawings amount in the current account. Drawings. Oh, there is a question, and let me come back to that. 200. Okay, there is a question. Why we don't show the interest on loan 25 on current account for Ajithan because he is retired in the opening at the beginning. Okay, so he retires at the beginning. So end of the year, he is not in the business. That is why beginning itself, we closed his current account. Now we don't have a current account with us because he is retired at the beginning. And the interest on the loan was paid at the end. Then when we are paying an interest, right, when we accrue the interest, it goes to the interest payable account, which comes under statement of financial position, current liabilities. So this interest 25 is a current liability. SOFP. Right. Next, all sales and purchases of the partnership are made on credit basis. During the year, 1.8 million was collected from debtors, while 900,000 was paid to creditors. Okay, so let's find out the sales, purchases. So to find sales and purchases, we need debtors account and creditors account. Trade debtors and trade creditors. Okay, so first I will prepare the trade debtors account. Trade debtors opening balance is 450. Balance brought forward 450. Trade debtors and closing balance also given at the bottom. Trade debtors 500. So balance brought forward, closing balance is 500. Closing balance. I'm doing the debtors account. Then the cash received from debtors. Cash received from debtors is given. All sales and purchases during the year, 1.8 million was collected from the debtors. So cash received means cash account debit, debtors account credit, 1.8 million. And the difference will be the sales. All the sales were on credit. So this is the sales. There is no cash. 1,850 is the sales value. $1,850 is the sales. Okay. Now, same time, we can do the trade creditors to find out the purchases. Opening trade creditors 200. Transfer over 200. Closing. Yeah. Trade creditors. It's 300. Cash and purchases. Cash 900 was paid to creditors. 900. So 1200 minus 200 is 1000. Purchases 1000. So we did the trade debtors and trade creditors. Trade debtors and trade creditors. Right. Operating expenses paid. Okay. Now, in the meantime, we need to find out the cash. We need to prepare the cash book, cash account. right? Then we can see for any differences. Sometimes there can be differences, right? So hopefully in this question, we don't see any difference, but if required, we might have to prepare a cash account. Opening balance is 60. Then from the debtors, we get 1,800. Creditors, we pay 900. Operating expenses paid 350. Operating expenses paid 350. $350. That is an expense. That comes here. Operating expense 350. And also there's cash drawings. That also we can do 350. This total 350. But it's interest on loans are payable, to be paid. Interest on loans are to be paid. Still we have not paid, so it doesn't come to the cash, but we need to record the interest payable. 5% loan from Narada. It's an non-current liability. So expense, interest on loan. %5 into 5% is 10. That is payable. Interest on loan. PPE should be depreciated on cost at 20% annum on straight line method. That is a depreciation expense. So the PPE cost is 1 million. 1 million into 20% is 200. 200. So we have covered almost everything. Cash closing balance is 260. But if you balance the cash to debit side, total is 1,860. Credit side total also 1,860. So there is no difference. But sometimes you might have to find out the closing balance, or sometimes there can be differences in the debit or credit side. So here there is no difference. Right. So other than this, we have stock, opening and closing stock. Opening stock is given in the balance sheet, 200. Closing stock, 275. Yeah. That's all. Can you all complete this? Net profit is minus net profit is 340. Share of profits 100, that will be divided between the partners M and N equally. So that is current account, M and N 50-50. That's all. Balance the accounts. Did I miss anything? Narada's loan interest, yeah, you can take it under current account. That's fine. Narada's 5% loan interest is 10. We can take here 10,000. It has already taken. But you don't take Rajita's loan interest. It goes to current liabilities in the statement of financial position. How did I take it? Oh, sorry, I missed it. Okay. Right. Any questions? Right. Let's do another question. I'll do another past paper. Okay. 2000. Okay, let's do this. A partnership with error corrections. Right. So you all have done error corrections. And here, first you need to find out the adjusted profit. Right. There are errors. Amal, Kamal, Nimal carried out a partnership under the following terms. The journal entries to correct the errors, statement showing the correct profit, and the capital and current accounts. Okay, I'll give 10 minutes. Can you all do this question?
Okay, so let's quickly this question. All partners are entitled to an annual interest of 10% based on opening capital balance. Kamal and Nimal in the ratio of 3:2:1 respectively. Profit for the year ending 31st March 2017 of the partnership. Before appropriation at 3,400,000. However, the following errors in the accounting records of the business were revealed subsequently. So there are errors. So we need to correct these errors. So net profit $3.4 million. Before the error correction. Then it says on 31st March 2017, Amal retired from the partnership. 31st March 2017. Right? On this date, the goodwill of the partnership was estimated 1.8 million. A goodwill account is not maintained in the books and all the adjustments are made through the capital accounts of partners. It was agreed to maintain the amount payable to Amal as a loan in the partnership. Kamal and Nimal agreed to continue the business sharing profits and losses in the ratio of 2:1 respectively. The credit balances of partners capital and current accounts 2016. Right. So that means Amal is retiring at the end of the year. Amal is retiring at the end of the year. Okay. So let's do this question. Opening balances, capital account, balance brought forward, 4,200, 3,000, and 2,000. Current account, all credit balances, 800, 500, and 300. Then first of all, we need to do the error corrections. Right? To do the error corrections, I'm going to use the general journal. Right. And also, we need to find out the correct or adjusted profit. Now, before the correction of errors, the profit was 3.4 million. According to the draft income statement, the profit was 3.4 million. After the corrections, we need to find out the profit. Therefore, we also need statement of adjusted profit. Statement of adjusted profit. I'll draw that here. Before the adjustment, profit is 3.4 million. 3,400. Okay. Right. Now let's do the error correction. Salaries of employees 360 has been debited to salaries account as 630. So this is an error only in the salaries account. Then what you do? Debited more. 360 debited 630. So we have to credit the salaries account by salaries account, we have to credit. How much is the difference? 630 minus 360 is 270. And suspense account, because the other accounts are correct. Therefore, we have debit the suspense account by 270. Narration, you can correction of salaries 360 debited to salaries account as 630. You can write the narration. Number 2. The interest paid 100,000 on bank loan has been credited to interest income account as 10,000. Interest paid 100,000. Credited to interest income account as 10,000. So this is not interest income. So first we have to remove this from the interest income account. So interest income account, debit the wrong amount of 10,000. It's not interest income. Therefore, we have to debit. Okay. We have to debit the interest income. And now we need to record the correct double entry. What is the correct double entry? Interest in. It's interest payment. Interest expense account. $100. And they are not telling about the bank account or the payment, the cash or bank account. So we assume that that is correct. Okay, so the opposite account is suspense. Total 110. We have to credit suspense account 110. Interest paid credited to interest income account. They are mentioning only about interest income account. Therefore, we have to adjust it to the interest income account and interest expense. Number 3. Office equipment 300,000 purchased on 1st of April 2016 has been recorded as office expenses. Depreciation is provided 10%. Okay. Office equipment purchased has been recorded as office expense. Office expense is a debit entry. So we have to remove from office expense. That means credit office expense and debit office equipment. Office equipment debit. Debit. Expense credit. 300. So that is a correction of the office expenses. And we need to provide further 10% depreciation. Once you transfer to the office equipment, we have to provide depreciation. 1st of April is the purchase date. Year end is 2017, 31st March. So 1 year depreciation should be provided. Office equipment depreciation account debit. 10% means 30,000. Office equipment provision for depreciation account is credit. Depreciation account debit. Provision for depreciation account credit. Amal's annual life insurance premium 150,000 has been paid by the business. It has been treated as insurance expense of the business. So this is not insurance. This is drawings. Okay. Therefore, drawings account debit, drawings DR 150, insurance credit 150. So those are the transactions for the error correction. Right. Now, once you do the error corrections, you can find out the adjusted net profit. You can find out the adjusted net profit. Okay, so the next part is very important. Now you have the general journal. So those are the adjustments for the accounts, right? And you need to do the correction for the profit. So can you all tell me what affects the profit? What are the accounts which will affect the profit? What are the accounts which will affect the profit? Yes, income accounts and expense accounts. So identify here income accounts and expense accounts. Only the income and expense accounts, nothing else. Whatever I am highlighting here, these are the income expense accounts. This is an expense account. This is income, expense, 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 insurance expense. Okay, right. So there is a concept where income or expense, if it is credit, profit will increase. This credited. These credit accounts will increase the profit and debit accounts will decrease the profit. Debit means decrease. So it's very simple. So there are three accounts which is in the credit side. Salaries, office expense, insurance expense. This is expense. And this is also salaries expense. And remaining three, interest income, interest expense, office equipment depreciation. These are in debit side, therefore minus. Okay, so 270, 300, 150. Interest expense is 100, 10, 30. Adjusted profit is 3980. Adjusted profit is 3980. So that goes to profit and loss appropriation account. 3980. Okay. So that's about error correction. Now let's do the retirement. Any doubts? Now let's do the retirement part. So we have the net profit 3980 adjusted net profit. Okay. We retired at the end. Okay. So we'll do this. All partners are entitled to interest of 10% on opening capital. Profit and loss 321. So let's do those two transactions. Amal, Kamal, Iman. 10% from their capital balance. $4,200 into 10% is 420. Kamal 3,000 into 10% is 300. Nimal 2,000 into 10% is 200. So interest on capital 420, 300 and 200. That will be credited to the current account. Interest on capital. Interest on capital. And there was one more transaction which comes from here, drawings 150, which is Amal. Yeah, Amal's life insurance. So before I forget it, I'm writing here. Right now, find the profit share. $3,060. Old ratio is 3:2:1. 3:2:1. 3 means it's half. 3,060 into 3/6. Share of profits to the current account. Now we can do the retirement. On 31st March 2017, Amal retired. And when retiring, the goodwill was estimated as 1.8 million. Right? What is the double entry for goodwill? Old ratio credit, new ratio debit. Okay, I'll write the summary. Old ratio is 3:2:1. So Amal, Kamal, Nimal, 900, 600, and 300 credit to the capital account. New ratio is 2:1. Only K and N, Kamal and Nimal. So let's record that in the capital account. Goodwill, old ratio credit. Old ratio credit. And new ratio debit. Old ratio credit, new ratio debit. Old ratio credit, new ratio debit. Okay. Now the retirement part. Amal is retiring. So whatever payable to Amal from the current account, we need to transfer to the capital account. Amal, credit side is more. So the total of credit side is 2,750. Difference is 2,750 minus 150 is 1,600. So that will be transferred to capital. Transfer from current account. Transfer from current account. Then the current account balance transfer to the loan account 7,700. So that will be transferred to loan account. Okay, current account balance we transfer to the capital account. Capital account balance we transfer to the loan account. That's it. Then you have to balance the rest of the question. Closing balance. Get the closing balances. $1,824 current account, $1,824 Kamal, 1,010 for Nimal. And finally, the capital account, Kamal 3,600 minus 1,200 is 2,400. 2,300 minus 600 is 1,700. So get this 2,400 and 1,700. Right. So that's it. You can complete other question. Any doubts? Don't have any questions? I can ask. Otherwise, we can complete the question. Okay, so complete this question. I will share some more questions for you all to do. Do those questions also, right? If you all have doubts, we can discuss them during the weekend. Okay, so we'll conclude today's session. Most probably, I will try to have some extra sessions during the weekend. Okay, so good night and take care.